Hey everybody, welcome to Mortgage Today for Tuesday, June 18th, 2024. And oh, what a day it was. Although they were small numbers, at least they were green this morning. We were up a couple of basis points, 6 to be exact, in the first hour of trading. Bonds were unchanged overnight and in position to move in either direction in response to this morning's retail sales data. A mere miss of 0.1 versus 0.2 in retail sales has resulted in an immediate and obvious bond market reaction, even if it wasn't that extreme in terms of level of improvement. Retail sales, like I said, came in at 0.1 versus a 0.2 forecast. Year over year, it's up 2.3%. We are starting to see more evidence of the consumer getting tired, which kind of means they're running out of credit card debt, which kind of means they're running out of credit card capacity. Retail sales in May rose only 0.1%. If you strip out the vehicles, retail sales fell 0.1%, excluding vehicles and gas. Retail sales rose 0.1%. Excluding vehicles and gas, retail sales rose 0.1%. April numbers were revised downward from flat to a 0.2% decrease. Market was probably more reacting to that than anything else. S&P futures were up 2 points. We also got Philly Fed President Patrick Harker, who sees one rate cut this year and said the Fed is surrounded by an air soaked with uncertainty. Inflation in the U.S. is still being driven primarily by the shelter component. And we are seeing rent increases pick up after a brief slowdown. Asking rents are roughly flat on a year-over-year basis, but that is primarily driven by the Sun Belt, where there is a glut of new supply. Rents are rising in the Midwest and the East Coast, especially in the Washington, D.C. area. Bonds traded the day in two distinct sessions. First up was a reaction to retail sales data with a logical rally following the weaker results. Gains weren't especially huge, and the modest correction lasted until about 11 a.m. At that point, the second shift began, with volume profiles suggesting position squaring ahead of Wednesday's holiday closure. The preponderance of Fed speakers could also have been deemed supportive, but the timing and trading volumes don't support that conclusion very well. The mini bull run ended with a 20-year auction, which caused a brief two-way trading without leaving a lasting impression. Bonds were flat after that and closed the day a total in net up 18 basis points at 100.76. So if we look at 100.76, we're once again coming up to try to test that Fibonacci line at 100.82, which has held a tight lid on things, so we need some more bad news to break through that, and we got multiple floors converging around that 100.427 mark. We also got a cute post here. We also got a good post here from the Bowtie Economist. There is some talk of replacing 100% of the income tax revenue with tariffs on foreign goods entering the United States. This will be hard to do. In fiscal year 2023, corporate and individual income taxes totaled $2.6 trillion, excluding payroll taxes. Total imports for fiscal year 2023 were $3.8 trillion. To raise enough money, the average tariff on imports would have to be 68%, which, assuming quite unrealistically no behavioral changes on the parts of buyers.